Okay, let's just get right into it. The 2026 RBI rate cut cycle is officially upon us, and honestly, it's a massive shift. Analysts are expecting this to play out over several quarters. But what does all this macroeconomic jargon actually mean for your money? Well, today in this explainer, we're going to break down exactly how this cycle hits your wallet. Whether you're a regular depositor watching those FD returns shrink, a home loan borrower pulling your hair out over high EMIs, or an NRI managing wealth from across the globe, we've got you covered. Because here's the million-dollar question, right? You see the news alerts, RBI slashes rates, and you're pumped. You log into your banking app the very next day, fully expecting your monthly outflow to drop, and nothing. Your EMI hasn't budged a single rupee. It is so incredibly frustrating. So let's solve this relatable banking mystery together and look at the actual mechanics banks use behind the scenes, and more importantly, how you can position yourself to come out ahead.
Let's kick things off with Section 1, the rate cut chain. To really get why your EMI is stuck in the mud, we first need to look at how things should work in a perfect world. A rate cut cycle is basically a sustained period where the Reserve Bank of India steps in and reduces its key policy rate, which is primarily the repo rate. Why do they do this? Simple. To lower borrowing costs, stimulate economic growth, and basically get people spending money again. The repo rate is literally the biggest lever the central bank can pull. When they drop it, overnight borrowing becomes cheaper for commercial banks.
So logically, it sets off this perfect little domino effect. First, the RBI cuts the repo rate. Boom. Step 2, banks' own borrowing costs from the RBI go down. Step 3, because their costs dropped, banks lower their lending rates to you and me. And finally, Step 4, your home, car, and personal loan EMIs finally drop, right alongside fixed deposit rates. In theory, it's a beautiful, elegant chain reaction. But, well, you know there's a but coming, right?
Which brings us to Section 2. Why EMIs stay stuck. In reality, that perfect domino chain we just talked about, it almost always breaks before it actually reaches your bank account. If your EMI is stubbornly stuck, it really comes down to which side of this divide your specific loan is sitting on. On one side, we've got MCLR. That's the marginal cost of funds-based lending rate. This basically translates to slower transmission because it depends on a specific reset date. On the flip side, we have EBLR, or the external benchmark lending rate. This gives you much faster transmission because it's directly pegged to the repo rate. This right here is the absolute game changer. It's the whole reason some loans react instantly while others just refuse to drop. Let's zoom in on that transmission lag for a second. If you're sitting on an MCLR-linked home loan, your rate only resets annually, or maybe semi-annually. That timeline is hard-coded into your loan contract. So think about it. Even if the RBI cuts rates today, and your bank actually lowers its MCLR tomorrow, if your particular reset date isn't for another 6 months, you are not going to see a single rupee of EMI relief until that exact date rolls around. You're basically just stuck in the waiting room.
But hey, it's not just about reset dates. Let's pull back the curtain on why banks actively drag their feet on passing these cuts along. First up, they are fiercely protecting their net interest margin, which is banking speak for safeguarding their own profits. Second, if banking system liquidity is tight, meaning cash is scarce, they just won't pass on the repo rate cuts right away. They need the cash. And third, if you sign up for a fixed-rate loan, well, you're entirely immune. That means you're safe from rate hikes, sure, but you also miss out completely on rate cuts. The RBI's moves literally do not apply to you.
Let's put this into perspective with a real-world example. Take Ramesh. Let's say he has a 50 lakh rupee home loan. Because Ramesh was smart, or maybe just lucky, and got an EBLR-linked loan, his transmission speed is super fast, usually within the quarter. If the RBI drops rates by 50 basis points cumulatively, Ramesh sees his EMI drop by about 1,500 to 2,000 rupees a month. Not bad, right? But take a standard MCLR borrower with that exact same 50 lakh loan, whose reset date is still 8 months away. Their EMI impact? Absolutely zero. Over an 8-month stretch, the mathematical difference between those two borrowers is just massive.
All right, moving on to Section 3, Smart Moves for Fixed Deposits.
So, we know banks take their sweet time lowering your EMI. But guess what? They are lightning fast when it comes to dropping your deposit returns. It's funny how that works, isn't it? When the RBI cuts rates, banks suddenly don't need to pay high interest for your deposits. Usually, fixed deposit rates plummet within 30 to 90 days of the RBI's announcement. Sure, some small finance banks might hold out a little longer to attract customers, but the overall trend is straight down. You have a seriously tight window here. The smart money move? Lock in those longer tenure FDs right now, before your bank slashes rates any further.
So how do we actually do that?
Enter the FD laddering strategy. As fixed income returns start shrinking, please do not just dump all your savings into one massive single FD. You've got to stagger your maturities. Think of it like building a staircase. Put some money in a 1-year FD, some in a 2-year, and some in a 3-year. This strategy is brilliant because it lets you lock in today's attractive long-term rates, but you still keep your liquidity flowing since a portion of your money matures every single year.
But wait, before you open your banking app and start breaking all your current FDs to restructure, let's talk about the catch. 0.5% to 1%. That is the penalty you're typically going to get hit with if you prematurely break an existing FD. So if you're tempted to smash an old deposit just to lock in a new long-term rate, you absolutely have to do the math first. The new interest rate has to be meaningfully higher to actually offset that penalty hit. Otherwise, you're just losing money.
Let's shift gears for Section 4, the NRI playbook. I want to specifically talk to our viewers tuning in from outside India. Whether you're in the US, UK, Canada, the UAE, Australia, wherever you are, this segment is mandatory viewing. This RBI rate cycle hits you in 3 very distinct ways. Number 1, NRE fixed deposit rates will decline, period. They're directly tied to domestic rates. Number 2, a rate cut environment usually weakens the rupee, which surprisingly boosts your remittance value. And number 3, if you're paying off an NRI home loan, you are going to see some gradual relief. Let's break these down, starting with the NRE deposits.
Just like the domestic market we just talked about, the rates you are currently getting on NRE fixed deposits will definitely fall as banks begin to reprice. You need to look at your portfolio today. If you've got large NRE FD maturities coming up anytime in the next 6 months, you seriously need to consider locking in longer tenures right now. Do it before the next domestic rate cut forces your NRI branch to slash your returns. Time is literally money here.
Now, let's talk about the currency side of things, because it is kind of counterintuitive. Rate cuts generally lower the return on INR-denominated assets compared to foreign currencies, which leads to a weaker rupee. Now, if you're an investor who measures your wealth strictly in US dollars, yeah, that's a bummer. It means lower USD equivalent returns. But what if you're remitting money? What if you're sending cash home to family? Then a weaker rupee is fantastic news. It means every single dollar, pound, or dirham you send converts into more rupees on the other end. The real-world value of your remittances gets a massive boost.
Let's look at how this plays out in the real world with Priya. Priya lives in the UK, but she took out an NRI home loan to buy a flat in Bangalore. Her loan is in Indian rupees, and it's floating, linked to the EBLR. So RBI cuts rates? Great! Priya's EMI drops. But wait, it gets better. Because the rupee is weakening against the British pound, that exact same loan actually becomes cheaper for her to pay off in GBP terms. It's an absolute win-win. Priya gets a double benefit from both falling interest rates and shifting currency dynamics.
Finally, let's wrap this up with our summary: myth versus reality.
We have covered a ton of ground today in this explainer, from transmission lag to FD laddering to NRI currency plays. Let's do a quick rapid-fire recap to bust some myths and really reframe how you read financial news. Myth: the RBI cut rates, so my EMI is going to fall instantly. Reality: that's only true for EBLR loans. MCLR loans are stuck waiting for their reset date. Myth: FDs are totally useless in a rate cut cycle. Reality: FD laddering is still an incredibly valid strategy if you lock in your tenures right now. Myth: a weak rupee is bad news for everyone. Reality: it actively increases the value of remittances for NRIs sending money back to India. And lastly, myth: savings and FD rates drop at the same time. Reality: not quite. Savings account rates are super sticky, but those FD rates, they respond and drop much, much faster.
Which brings us to one final question for you to chew on. Are you actually positioned to take advantage of the 2026 rate cut cycle, or will you let the transmission lag cost you money? Seriously, take some time today to check your loan agreements. Find out if you're on MCLR or EBLR. Rethink those FD strategies before your bank makes its next move. Thank you so much for hanging out with me on this explainer, and I highly encourage you to go review your personal finance setup right now.